Hello, in this video I'm going to cover section 6.10, credit cards from Contemporary Mathematics by OpenStax. And so in this section we want to be able to apply for Credit Card armed with basic knowledge, distinguish between three basic types of credit cards, compare and contrast the benefits and drawbacks of credit cards, be able to read and understand the basic parts of a credit card statement, and compute interest, balance due, and the minimum payment due for a credit card. So with the economy the way that it is, a lot of people find it very difficult to be able to get along without at least one credit card. It's not impossible, it's completely doable, but many people rely on credit cards to be able to get from one paycheck to the next, especially for individuals who maybe only get paid once a month. So not only that, things like hotels and car rental agencies require that you use a credit card. However, now with the growth of debit cards and those types of things, not as necessary, but some still do want credit cards over, for example, a debit card. So one important thing to know about credit cards is they tend to have higher interest rates regardless across the board. Some of the highest interest rates I've seen on credit cards are upwards of 32% interest APR, and that is very high in terms of interest rates. Some credit cards have what are known as annual fees, which is literally a fee that you have to have and you pay every year in order to just have the card. And it's not an optional kind of thing. You have to pay it in order to receive the card. I would argue that there are more cards out there that do not have a fee than there are cards that do have a fee. But there are some cards that do have annual fees. There are cards that have rewards programs. So one example that I am familiar with is the Amazon rewards program. You get up to 5% back in Amazon points that you can use to purchase things from Amazon. There's also a Sam's Club credit card that gives you percent back in cash that you can use at Sam's Club to make purchases. There's Belk has their own credit card that they give rewards for, such as $10 for every like $100 or something that you spend. So there's rewards programs a lot of times to incentivize people to sign up and use credit cards. If you're paying off the credit card every month, then because you have a zero balance when the bill comes due, you've paid it off, then it's important to note that no interest is charged on a zero balance credit card. And so the rewards program is a paid benefit to you. But if you keep a balance on a credit card and you're paying interest, then a lot of times the rewards programs do not outweigh the interest that you're having to pay. And so from that, from a return on investment type of perspective, rewards programs are not beneficial if you're having to pay the interest on it. The other thing about credit cards is they do have a limit. They're called the credit limit that is offered. This can range from, if you're getting a credit card for the very first time, it could be as low as $500. It could be high as $20,000. And then if you're working with a business and you have a business credit card, it could be as high as $100,000, maybe even $1 million. For some businesses with credit cards. But for the average consumer, you're looking at anywhere from $2,000 to $10,000 limit, and that's a huge range. But all of this, the fees, the credit limits, the interest rates, all of that goes back and is highly dependent on your credit score. But one important thing to know, and I've highlighted it and I'll say it again, is if you pay off your credit card balance every month, then no interest is charged, and that's important. Or if your credit card offers a 0% interest rate for a certain time limit, then as long as purchases are made within the time limit and paid within the time limit, then you also will not pay any interest. So there are 3 types of credit cards. Let's highlight that sentence because that's one of our objectives for this section. They're bank-issued credit cards, store-issued credit cards, and travel and entertainment credit cards. So bank-issued credit cards are your big credit cards that come. Those are your MasterCard, your Visa card, all of those. Those are issued by a bank. They are attached to a kind of a revolving line of credit that we talked about in the last section, and they have that limit, and you can use them anywhere. That's really the point of a bank issued credit card, is that you can use them anywhere. A store issued credit card is specific to that store. Those are becoming more and more rare. They're not as common as they used to be. For example, Belk used to have their own card, and you can only make purchases with the Belk card at Belk. Well, now Belk has a credit card that is a Visa card that you can use anywhere. The Amazon card is a Visa card. It can be used anywhere. Even companies like Apple, the computer company, they have a credit card, and it's a MasterCard, and it can be used anywhere. But it's also a rewards card because you can get rewards for making purchases at Apple. So, again, store-issued credit cards usually can only be used at that store unless it's backed by a bank, which often nowadays it is. So store credit cards have an APR of 24.15%. So, regular credit cards, quote unquote, your bank issued credit cards can have lower interest rates, mainly because they're backed by a bank, not for example, not for a store like Amazon. Store-issued credit cards tend to have higher interest rates because they're having to pay an underwriter, which would be a bank, and then they're also trying to make a profit off of that as well, so they're going to have a little bit of a higher interest. They're also going to have rewards usually associated with it, and so that's going to get folded into the interest for individuals who don't pay off their balance. They're going to help pay for those rewards because they're paying the interest. And then you have travel and entertainment cards. Again, I think those are even more rare nowadays. They generally charge high annual fees and impose expensive penalties should a payment be late. And this, again, these are getting more and more rare, but this could be like your an Experian or Travelocity type credit card where you're getting those points for traveling and stuff. It's kind of like that. They usually have very high limits or an unlimited credit, which is, kind of crazy. But they have to be paid in full every month. And if you do not pay it off, not only is it charged interest, it's very high fees. So there's a NerdWallet article about all these different types of credit cards. I highly advise you click that link in the textbook and check it out. So again, let's compare credit cards. So which type of credit card is paid off every month so that it has no interest to be paid but comes with high fees? So that's going to be your travel credit card. Which type of credit cards are most widely accepted? That's going to be your bank-issued credit cards. And what types of credit cards are the most limited? That's going to be your store-issued credit cards. So looking at those 3 examples, that's how you can kind of, if you're looking to get a credit card, ask yourself, do you want the most flexibility? That's going to be your bank issued. Are you looking for something specifically at this particular store, like at Best Buy, with specific Best Buy rewards? Then you want a Best Buy credit card. And then if it's entertainment or traveling, of course you're going to go for an entertainment or travel credit card. But it has to be paid off every month and has extremely high fees. So kind of keep that in mind. Let's look at an example of a credit card statement. So here in this figure, when you get a credit card statement, it sort of looks like this. This is just boilerplate from the book. Every credit card company has their own branded type credit card. So in this case, we have the new balance. This is saying that on May 6th, rather, the due date that's when this is due. So this was probably sent to her probably about a week or two before this date. And this person has charged $668.25, or they had money remaining that they needed to pay on. That was added, and then interest was charged. But regardless, in order to pay off this current credit card, $668.25 is the balance. The minimum payment is $40. So minimum payments on credit cards are a little interesting. It's usually either a percentage or just a number. In this case, we're looking at $40, which would be kind of a lower bound threshold that the credit company is saying that you have to pay. But if you had like a balance of $10,000, then your minimum payment would go up, and you wouldn't just pay $40. You'd probably have to pay closer to $100, because it's usually about 10 or 15% of the balance, or $40, whichever is higher. And so if it's 10% of 10,000, you're talking about $1,000. So you'd need to make $1,000 payment as a minimum payment. As we're here, it's pretty low. In fact, 10% of this is 60, so maybe this has a 5% minimum payment. It really depends. So if you only make the minimum payment, again, they even give you this warning a lot of times, it's going to take you longer to pay off your balance, and we'll talk about that. This has an this is a late fee, and if you are late and you don't pay your $40 minimum payment, not only are you probably going to be charged a late fee, but you're going to increase your APR as a penalty to 29.99%. And that's something that credit card companies can do. Another thing that changed in a couple of years ago in federal law is that they have to give you this breakdown for payoffs. And so if you only make the minimum payment for every month to pay off this loan, they calculate it's going to take you 19 months to do that. And you'll end up paying an estimated $754 in order to do that. So they do this so that you understand the impact of only paying the minimum payment. Yes, you can. You can only pay $40, and you're well within your rights, and they're not going to send you to a collection agency. But it's going to take you over a year, right? Almost over a year and a half to pay off this credit card, and that's assuming you never use it again. So let's look at this credit card statement down here. It's a little different. Like I said, every credit card's different. So what is the current balance, or the balance due? For this credit card, we're looking at $3,663.23. And so the minimum payment is $36.63. So what that tells me is this credit card has a 10% minimum balance or minimum payment. So if you just do 10%, move the decimal place, I guess that would be 1%. Just move the decimal place 2 places, then you're looking at $36.63 minimum payment. The payment is due on May 24th. And if we go down and what length of time is it going to take to pay this off, that should be in this statement. And so if you only, right here it is, estimated time to pay your new balance. If you only pay the minimum payment, it's going to take you 2 years and 4 months to pay this off. And that's kind of crazy. That, if you pay about $36 a month, and that's going to go down because of the principal is going to go down. It's going to take you 2 years to pay that off, which is a lot. And what is the interest rate for purchases? They also have to list that out. So the annual interest rate for purchases is 19.99%. So you're looking at a 20% interest rate for purchases, which is fairly high. That's double what it is to purchase a car. So, but this is what a credit. This is pretty accurate to what a credit card payment or statement would look like, with all the pertinent information required by law. What's not mentioned up here is like, what's your limit? Well, $9,000 is the limit. So this person could borrow or, purchase things up to $9,000. There's also cash advance, which means you could go to an ATM and use this card to get out cash. Now, for this card, it's kind of nice. So cash advance interest rates is actually the same on this card, but it doesn't have to be. In fact, most cards that I've ever had, the cash advance rate is higher than the interest rate for purchases because you're using it as a loan at that point with no kind of collateral, so to speak. Because when you purchase stuff on a credit card, you usually get services or items, but cash is usually charged at a higher interest rate. But for this card, it's not. It's actually the same, which is a little odd. So computing interest, balance due, minimum payment, and all that for a credit card. Credit card math is it can get a little crazy. They use something called the average daily balance, which is something that's supposed to make it more fair on the purchases that you make. But it also does end up complicating the math just a little. It adds a little complexity to it. So the way the average daily balance works is, if an item is purchased at the beginning of the month, then it is kind of weighted higher because it carries throughout the month or until a payment is made. And so we're going to look at this textbook example, but basically you're just adding up the balance for every day and then taking the average of that over the year. So let's look at this example. So this is a credit card, kind of a log of what was purchased. So the balance at the start of the billing cycle on May 1st was $451.21. And then on May 10th, this person made a payment, which would reduce the balance by $120. Then on May 15th, they bought some groceries for $83.43. Then they purchased some auto parts for $45.12. They went out to eat at a restaurant for $85.34. Then they purchased shoes. So payments are going to be negative deductions, and then purchases are going to be positive because you're adding to the balance. So we want to find the average daily balance for the credit card during the month of May. So the way we do that is, again, purchases or carryover balances are positive, purchases are negatives. Then we have to say, well, how long was this balance on the book? So from the 1st to the 10th, that's 9 days that the balance was $450.21. So, and then from the 10th to the 5th, because when we, kind of look at it this way, on the 10th, the balance goes down to $330.21. Then they made another purchase on the 15th, which is going to increase the balance. Then on the 26th and the 30th increases the balance. So when we go to calculate it, it was 9 days from the 1st to the 10th that the balance was $450.21. And it was 5 days from May 10th to May 15th that it was $330.21. And then from the 15th to the 26th was 11 days. So it was $413.64 for 11 days. And so you get the picture that this is how many days it was with that balance. And then from the 30th to the 31st, it would have 2 days of $642.33. So we would then multiply the balance on the days for the number of days that it was there. So for example, 450.21 times 9 is 4,051.89. That's going to be the sum of the balance. And then we add it all up. We add all of these numbers for the balance times days, and that gives us $13,714.04. Now there's 31 days in May, so we divide that sum by 31, and we get $442.39. That is the average daily balance. So that is kind of on average, how much money did you have on the credit card? And that would be $442.39. So that average daily balance is what's used to calculate your overall interest for the credit card. And the reason that that's kind of quote-unquote most fair is because you see for the first 10 days it was $451. For the last 2 days it was $642. Well, if they charged you interest on just the last day, which would be $642, then that doesn't do you any favors by saying, well, for several days I had less than $400 on the account, on the credit card. And only for the past, 2 weeks did I really get into the $500 and $600 balance. And so the average daily balance helps kind of take the lows with the highs and gives you somewhere in the middle of where it should be. And so that's, it can work out to your benefit, especially if you end the month, which most people do, with higher credit card balances, because you make payments or purchases rather throughout the month. And so this helps bring that overall balance down. So try the U-Try. It's a good example of how to do that. But let's keep moving on to the interest charge for a credit card during a billing cycle, and that's given by this formula. ADB is the average daily balance times the rate times the days divided by 365. And so some billing cycles have 30 days, some billing cycles have 31 days, and of course we round up to the next penny. So average daily balance times the rate as a decimal times the number of days in the billing cycle divided by 365. So we're kind of balancing in this out on a daily basis in that case. So let's look at a quick example. I'm going to grab a calculator here. So we want to compute the interest charge for the credit card based on the given average daily balance. So we've got an average daily, they've went ahead and calculated for us our average daily balance. So we've got $2,765 times 0.1399, and that's going to be times, it's going to be a 30-day month, and then we're going to divide that by 365. So in this particular example, number one here, we would pay $31.80 in interest for that particular billing cycle. Then for the next one, we would do 789.30 times 0.1799 times, it's got a 31-day billing cycle divided by 365. So here we're going to pay $12.06 in interest for this particular credit card and that average daily balance. And then the last one would be $1,037.85 times 0.1199 times 28, so this is February, not in a leap year, divided by 365. And so we're looking at $9.55. So let's make sure that those numbers match up. So we got $31.80, $12.06, and $9.55. So you can see how those numbers work. That is the interest that you're going to be charged if you did not pay off the credit card in full before the bill comes due. So again, I always encourage you to stop the video and try the Your Turn to see if you can calculate the interest rates given the average daily balance in these problems. All right, so let's try and put all of that together here. The average daily balance with calculating the interest. And so we want to determine Kalen's balance at the end of the billing cycle. So here, he's got a credit card. It charges 16.9% annual interest. Current billing period is from November 1st to November 30th. The balance on the first was $1,854.23. And here's a list of all of his transactions. So looking at this information, we've got a forward balance. So he started the month off with $1,845.23 from the last month. Bought some groceries, a tablet, online gaming, restaurant, made a $300 payment. So looking at this information, everything here except this 300 is a positive number. And so the 300 is minus. So what I'm going to do here is I'm going to grab a pen and I'm going to put a minus here because this is a payment that's going to subtract from the total amount. And we're going to figure out how many days, because we need the total number of days. We're looking at 30 total days. All right, 30 total days. And how many days was each of these balances on the account? So from the 1st to the 3rd, that's going to be 3 days. 1, 2, sorry, that's going to be 2. The 1st and the 2nd. And then groceries is going to have, well, we need to add 2. So let's look at how this works. So we've got these transactions. Again, the 10th is a payment, so it's going to be minus $300 on that day. So if we go through and we're adding, so we do, on the 1st we had that carryover balance, and we're going to add $78. So on the 3rd, our balance is going to jump. Then on the 4th, he made another purchase of $246.09. So our balance is going to add $246. Then on the 10th, we're going to subtract $300, so our balance goes down again. And then from there, we're adding each of those days till we get there. Now, in the next one, we need to figure out how many days did we have a balance of each of these balances. I hate to be a little redundant. But you can see from the 1st to the 3rd, that would have been 2 days. From the 3rd to the 4th would have been 1 day. 4 to 6 is 10 days. And so we get this total number of days until the balance changed. And then we multiply, in the next step, we're going to multiply the balance times the days. And that's going to give us this 3rd column or 4th column here. And what we're going to do now, once we do each of these multiplications, we're multiplying here. I'll write that. So we're doing multiplication here to get us this column. And then what we're going to do at the end is we're going to add this last column, and that's going to give us $62,190.95. Now, this is an average, so then we're going to take that and we're going to divide it by the number of days in the billing cycle, and 30 days. And then when we divide that, we get $2,073.03. So that's our average daily balance. And so we're going to bring that and we're going to plug it into our formula. So using that 2,073, I don't think I can paste it into, oh yeah. But we don't want these commas and stuff. And then we're going to multiply that by 0.169 times 30 days in November divided by 365. And that's going to give us $28.80. So that's how much interest is going to be charged. So how do we calculate his next month's balance? Well, he ended the month with $2,159.11 on the credit card. And then it's going to charge him that $28.80. And so when he gets his bill, it should be... So when he gets his bill, he should have a balance of $2,187.91, which is not what the book says. That's less. We shouldn't have a less balance. So looking at $2,187.91 as the total amount that he owes. So that is an error in the book again. But all right. And so last thing I want to talk about after that example is kind of the minimum payment due. I said this previously, but this is a good summary. So typically for minimum payments due, for larger balances greater than $1,000, it's usually a percentage of the balance due. If it's less than $1,000, then it usually ends up just being a small fixed amount, like $25. It could be $30, it could be $40. Sometimes it's depending on your credit score, what your minimum payment. Common ones I've seen, if it's a large balance, it usually says 5% or 10%. It could be upwards of 15%. So 15%, or something like $10 or $25 or $30, whichever's greater. So if you've got a credit card and you're carrying a higher balance, then that typically tends to be the percent. If you're carrying a lower balance, then sometimes it's just the dollar amount of the minimum payment that you have to pay. So just to kind of show you that in terms of, for example, here, in this last example we did, if it was said, 10%, then it would be $218 or let's say $40. Which one's higher? So this credit card would say your minimum payment's $218.79, or 80 cents rather, because we're going to round up, because you need to pay the percentage of the amount that's on the credit card rather than just the dollar, well, the minimum dollar amount, because you're carrying a higher balance. And that's actually good for you, because if you carry a higher balance for too long and you're only paying $40, then that just makes it like decades until you can pay off your credit card. So in this case, this is beneficial to you for them to set the math this way. So that's all I really wanted to talk about when it comes to minimum payments. There's, of course, an example here that you should read and look at, and then the your turns. But that's really all I wanted to talk about in this section, is really that average daily balance example. I hate that there's an error in the textbook. I'll submit a form about that to OpenStax so they can get that fixed. But that's kind of how average daily balance works. So hopefully you've taken some written notes, you've watched the video. Now it's time for you to go practice with the your turns, and then once you're done with that, head on over to the LMS and work on your online homework.